In last August, Tesla stock price has always been more volatile than the stock market. It closed the session on the lowest level since that time. Shares in the leading electric car market are now trading 38% below their peaks at the start of April and 43% below their all-time highs in November last year. Meanwhile, with the gas and oil price painfully high and a series of climate reports emphasize the urgency of moving away from burning fossil fuels, more individuals are expressing interest in electric vehicles. Hello everyone, we are Group 17, including members of Jeff and Wendy, and our research topic is investigating and forecasting Tesla's stock price by fossil fuels rise. Our contents through this video include introduction and a literature review, combined with the overview of the data interpretation. A time series forecasting will be involved in analysis price of oil and gas, followed by forecasting the stock price of Tesla and the existing prediction of oil and gas. Finally, is the explanation of limitation in modeling and an overall conclusion by current researching. As the leading EV producer, according to an estimated net worth of around US $265 billion as of May 2022, Elon Musk, the largest shareholder, is the wealthiest person in the world, according to both Bloomberg and Forbes Index. Tesla was an integrated automobile company that designed, manufactured, marketed, distributed, and serviced electric automobiles and electric automobile components. Tesla sales were growth more than 50% in 2022 compared with the last year, despite supply chain problems. Musk has said in early January, since battery price fell 35% in 2016 and are on track to make unsubsidized electric vehicles as affordable as the gasoline counterprice in the next 6 years. By 2014, long-range electric cars would cost less $22,000. Obviously, this isn't something oil markets are planning for. Plug-in cars would cost less and perform better than their gasoline counterparts, and found that electric vehicles could display oil demand for 2 million barrels a day as early as 2023. That will create a lot of oil equivalent to what triggered the 2014 oil crisis. In the recent year, overall oil and gas price was increasing steadily. The relationship between oil and gas and Tesla's price was ambiguous. But what we know is, every year the follows will bring more electric cars to the road and less demand of oil. Whether oil and gas price and Tesla's stock has interaction effects, the public event still was inevitable, such as Russia-Ukraine conflicts that influence oil and gas price potentially in March. It has been recognized by firms about the Tesla's growth in recent decade, including comments from Wall Street and a stock recommendation by each company. The second and third article emphasizes that how likely EV will influence or influenced by oil and gas. The VAR model is a statistics model used to capture the relationship between multiple quantities as they change over time. The last article examines the effects of fiscal policy on private GDP, inflation, and interest rate in Italy through VAR model, and investigates shocks to total direct government spending using the 6-variable VAR, which includes private GDP, the private GDP deflator, employment, the interest rate, direct expenditure, and next revenue. In predicting the time series data of gas and oil, the ARIMA model is necessary. In the first paper, we have concluded a study on 56 stocks and 7 sectors from empirical study of 23 months of data, evaluating the accuracy of ARIMA model. In predicting the stock prices, and the accuracy rate was 85% for all the stocks. Gauge models has been used to catch the price volatility of different commodities and assets. It was proved the gauge model is a suitable approach and not the stock market through COVID-19. Also was a convenient model to examine the relationship between each factor. The last article used Granger causality test to study the dynamic relationship between stock returns and dividend yields in the American and Japanese equity markets. Findings of the test is statistically significant, which receives surprising findings from tests, such as superior predictive power of dividend growth rate over the dividend price ratio. In forecasting Tesla's stock price for oil and gas price, our major question will focus on if the fossil fuel price will impact the Tesla stock price. The 5-year electronic index was downloaded from the SP Kensho, which included Tesla, Honda, etc. Since the SP index offers a reference and measures operation from companies in the electronic vehicle sector. In order to build our model, the oil and gas price also need as reference index as they take part in over half 50% of world's energy. According to 2020 Consumer Reports study, similarly show that EV drivers tends to be spent about 60% less each year on fuel costs compared to driver of gas-powered cars. Fortunately, All of our data have no missing and no values, and we can go straight into collecting the data. The closing price in trading days was collected since it offers standard benchmark, enable us to track its performance over time. A line chart gives trader clear visualization where the closing price of security has traveled over a given time period, in identifying certain patterns, graphs, and predicting the future observation between Tesla and the gas oil price.
In section 3, we are going to illustrate the forecasting model and the result for the oil and the gas time series. The aim of this section is exploring the future price change for crude oil and the natural gas. The fitness result or forecasting result will be used as an independent variable for forecasting the Tesla stock price in our section 4. We have 4 subsections in this section. Firstly, the time series transformation and stationary. As we all know, the basic idea of stationary is that the testing data will not be changed by time, which is a basic assumption for nearly for all time series analysis model. However, in real finance market, their data cannot be fully stationary. They need transformation to fit a stationary requirement. In the second part, we will use the forecasting model, the ARIMA model, to predict the future price. The simple ARIMA model has many disadvantages. One of them is it can reflect the volatility for time series. So we update the model into ARIMA gauge model in section 3. In the final subsection, the performance of 2 models will be compared. The predict number from the best model will feed the real price change to build a regression model that is used for predicting Tesla stock price in section 4. That is our structure for section 3. So moving to section 3.1, the left side is 5 kinds of transformation and their original time series. The 5 methods are 3 days moving average, 5 days moving average, the logarithmic series, the differentiating with lag 1 and the logarithmic series with differentiating lag 1. We then augmented Dickey-Fuller testing for all transformation and the original for both oil and the gas price. The testing value can be distinguished whether they are stationary or not. Surprisingly, even 2 original data are stationary with p-value under 5%, but we still take the last 2 models to do the future decision, which is different oil 1, different log oil 1, different gas 1, and different log gas 1. Then we compare the ACF and the PACF graph for 2 transformation of 2 data price. The performance for differentiating 1 and the log different 1 are similar. The only slightly better output is the non-logarithmic one has less tail off than the logarithmic one in PCF graph. And lastly, the PCF graph here mentioned to us that there is seasonal change. So ARIMA model. ARIMA model is a general of simpler autographic moving average and other notation for integration. When we build an ARIMA model for oil, firstly, we use the N-difference function in R as well as the AC graph hit in previous subsection. We got the best different integration number I equals to 1. Second, by AutoARIMA function in R, we get the auto best model ARIMA 312 with lowest ACI. Third, the AutoARIMA is not enough. We do manually adjust the model until all elements has a significant level greater than 5% and consider the seasonal change. Finally, we got our ARIMA model, ARIMA 312-201 with the lowest ACI 2500. So after building the model, we need to test whether it's usable or not. The Lewin box test is test for randomness, or statistical test for the presence of lag correlation in a time series. In the Lewin box graph here, since all point is about 5%, we can retain the non-hypothesis that the residual is white noise, which indicates that the model is fit well. The residual part is pure random data and cannot be captured. Well, the QQ plot can indicate again that residual are nearly normal distribution. So when we use the ARIMA model to predict the gas it's quite a similar process. But one thing I need to mention here is in ARIMA model for gas, the AM2 and AM3 are removed with a non-significant level. The residual plot is very good as well. So we use ARIMA model to predict the value for price change in next 100 days. The price of gas and oil has increased largely, but the gas price raised even more steeply. As can be seen from the prediction chart, ARIMA leg of analysis for volatility, it can be improved. So ARIMA arch model is come out. ARIMA arch is modeling the mean and variance separately. That is, the mean satisfies the ARIMA process and the residual satisfies the arch process. The tail of the arch model distribute are thicker than the tail of normal distribution. It is an improved model that can generate the forecasting for volatility. So when we build a ARIMA Arch model for oil, we keep the original best ARIMA model and add an Group17 to get a new model. So we keep the ARIMA model 312 and plus the Arch model G-Arch model 11. Testing for the result, we got a 3 plot. From the graph 1, we can see the 95 range of the oil volatility for the time series. The second one, for the 2Q plot, the model residual is normally distributed, which is great. And for the third one, we also predict for 100 days. It's still an upturn. It's similar to predict the gas price by ARIMA Arch model. The result and test is good as well. So last subsection, we use 588 training set and 13 test set. Compare the prediction accuracy for two models by graphing the real value and the prediction change. You can see that ARIMA win the comparison, which fit the real price change better for both oil and the gas change.
In forecasting Tesla price in future, we have divided into 3 parts: the causality test, time series model, and regression model. The time series for Tesla stock price are all stationary, as we just mentioned in section 3. What we can find from the graph, the Tesla and gas price are more centralized between each other. The oil price are more fluctuate, go through time by time. The Granger causality test will apply for whether oil and gas are useful in forecasting Tesla stock price, as the p-value are 0.3197. Hence, we can reject up now at 5% significant level. The chart below plots the cumulative sum of deviations from the target for individual measurements for subgroup means. We can notice that their upward or downward trend develops. The process may have shifted, and the process may be affected by special events such as public incidents, government policies, or international conflicts. Building our model and examine the relationship between gas, oil, and the stock price as they change over time. Determine optimal legs of 8 and solve a minimum AIC, the current Tesla price in relating with optimal leg of 8. Then we will use the lag for causality test. In comparing predicting and the real data of Tesla price, there's one point we can notice that was overlapping between each other, which means the VAR model is useful in predicting the stock price of Tesla. Generalized active model was built on our simple linear regression, which allows us to model nonlinear data while maintaining explainability in our regression. In our independent linear regression, gas and oil price are centralized and distributed mainly besides of the linear model and generalized active model, and their linear relationship of oil, gas, and Tesla stock price. In predicting stock price and oil, VAR model performs best as the graph demonstrates for consecutive 13 and 100 days. In predicting the stock price of Tesla in both short and long term, time period in short term are 30 days with real data and the long term are 100 days. Tendency in string models demonstrates similar in some periods as short term. However, in 100 days predicting, Tesla stock price and GAN model are more unrealistic, which shows us a negative results compared with VAR. Later performs better since they are stabilized in the long run.
Section 5. Section 5 is talking about the limitation and conclusion. Well, since the AVR model predict an unsatisfied result, we need to find out what might be the reason and how to improve the model. The first reason, and as well as the most significant, we believe, is there is an endogenous break for 3 time series. Therefore, we do a child test. In the table, we list all p-value. And you can see that for all the 3 price curve, they has a p-value below 5%. This is evident that the structure change exists. So what could be the break, or what could the reason of the break? We guess there are 2. Firstly, the war between Ukraine and Russia has dramatically forced up the price of crude oil and natural gas in a very short period of time. The second unexpected event may have come from Tesla. Tesla's factory in Shanghai is suspending work due to China's COVID-19 restriction. This interrupts the continual upward turn in Tesla's share price. For the future improvement, we can use the growth rate instead of the price itself when doing a prediction. You can see from the right side, the growth rate for 3 data has more regular variation over time. Most importantly, the growth rate does not have a structure break by the child test. Well, in summary, for gas price and oil price forecasting, both gas and oil price has been a certain sharp raise in the previous months. And by comparing the ARIMA model and ARIMA Arch model with the testing and training data, we can find ARIMA model has a better result. For Tesla stock price forecasting, we use a 10 series model, which is a VAR, and a regression model, multiple regression, a GAM model. GAM model has a higher accuracy on predicting the data in short terms, but VAR is good at predicting long term and is more reliable. So for the future innovation, we say there is an indulgence break for 3 of the time series data, and for future improvement, we will try to use the growth data instead of the actual price data. That's our presentation. Thanks all.